Hi, this is Bill Biederman from agmarket.net, and the reason we're putting this out is because the situation that the agricultural sector is in right now, I believe, is probably one of the most significant and most dynamic situations that we've seen, maybe in two other times in my entire 40-year career. So this is a really big deal, and I'm guessing that most people that are trading commodities or farming right now probably have never experienced anything as large as this potential scope of impact is. So I just wanted to take this time to indicate to you that we believe this could be a game changer, a career maker type of a move that's potential. I think it's still another 15 days out before we're going to have a better idea. But let me just show you some statistics. This is the corn planted progress. And right now, we're significantly behind. North Dakota's only 11%. They have a planting date that cuts off on January 25th, or I'm sorry, on the 25th right up here. That's only about 10 days from now. And on the 30th down in this neck of the woods. So you really only have 10 to 15 days left of planting, and the forecast right now going out 14 days is fairly cold and wet for this entire region right here. This could become a real problem. When you add up just North Dakota, South Dakota, and Minnesota, there's 18.5 million acres right there in corn. And if, let's just say, I don't know, they get 50% planted, and that's a lot of acres that may be written off. You know, people say, well, you can't write off any more than 2 million acres. Well, let me show you. In 1993, this was the area, and we drove it extensively. This is the area that was wet in saturated soils and caused planting delays. It was all along the Mississippi, the Missouri, and then up into the Red River and the Platte. And this was basically the areas that were flooded in 1993 and caused prevent planting. In 1993, well, we didn't have prevent planting, but we had an estimated acreage of 76.5 million acres, and we dropped 73.3. So we lost 3.2 million acres in what was planted, but we also lost acres that were planted that couldn't get harvested. We lost 6.3 million acres of harvested acres. And on top of that, there was a yield impact that was very dramatic. We lost 22 bushels per acre. So keep those numbers in mind, 6.3 million acres and 22 bushels per acre in production loss. Now, let me show you the saturated soil map or the outline area of that area. It's almost double of what we had in 1993. So we're talking about a significant difference. We're talking about 10 million acres easily could be significantly affected by this saturated soils. The forecast right now is for the Eastern Belt to improve over the next 15 days, which would be great because a lot of folks in Indiana, you can see they're only 6% planted. Many of our customers have not planted anything. Same with Ohio, only 4% planted. That's 43% behind normal. This is 51% behind normal. And Michigan is, I believe, only 3% planted. So this area here needs a dramatic turnaround. Now, even if they do get it planted, there's probably going to be a yield impact or a yield decline. Most guys that we talk to are saying probably around 10 bushels at this point. The U of I has dropped theirs by 10 bushels. So it's definitely going to impact production. Let me show you what the impact could be on supply and demand. Okay, so over here we have USDA is at 92.8 million acres, 176 bushel yield, production of 15, usage of 14.6. So we've got a slight increase in production over our consumption. So we get to see our carryover increase from 2 billion to roughly 2.5. Now, what we believe is you're probably not going to use as much of the old crop corn as we thought. So we're probably going to have a little bit more carryover, but just a smidge more than what USDA is saying. I'm going to be really conservative here. we're going to take 1.6 million acres off of USDA and end up at now 1.6. That's based on what we know right now. By the end of next week, that could easily go to 3. The week after that, it could go to between 4 to 6. It just depends. I mean, you know, like I said, we've got easily 10 million acres that we could start seeing problems with. It just all depends on the weather, and it's too early to know. But we do know that 1.6 is a pretty solid number because there's 1 million acres out west, and with Ohio, Indiana, and Michigan not planted, this is very conservative. We dropped the yield to 170 from 176. We feel that's a very conservative move. We leave the demand at 14.6. If you look back in history here, we've got solid demand, and everybody goes, yeah, but we aren't going to have China. Well, you don't need China. We have huge demand for corn. And so 14.6, we're going to keep it there. And so we're producing 14.2, consuming 14.6. That's a drawdown on carryover, and you end up with a 1.7, not the 2.5 that currently we are trading as traders. Now let me just play some games here. Let's just say we leave the acreage that high, but we take off 10 bushels. Remember, in 1993, we lost 22 bushels. So if I just take this down to 165, carryover drops to 1.3, stocks to use is down to 9, you're in the midst of a very select number of years in history that get this low. Let's put this back to 170, but come up here and be conservative and yet realistic, and we'll take 4 million acres off. Now we're down to 88.8 instead of the 92.8 that they intended. With a yield of 170, which is still, you know, that would be the 1, 2, 3, that'd be the 4th largest yield in history, a 170 yield. You'd be down to a 13.8 production, but you're consuming 14.6. You're down to a 1.3 carryover. Now, instead of being the 4th largest yield ever recorded, let's just take it down close to what we had a couple years ago. We had a record yield in 2015 of 168. So let's put it at 168, 2 bushels less. Carryovers down to 1.2. And if I go to 165, which is just, again, that's just a 10 bushel loss, not a 22 bushel loss, you're down to 959 million bushels, below a billion, 6.5 carryover. I can't tell you where the market would go. I'm just showing you the numbers, okay? So right now, let's go back to what we think is reasonable to believe where we're at right this minute. We're gonna go with a 1.7 carryover. That's still significantly less than 2.5, and you're getting very close to a very important carryover that doesn't occur very often. You'd be right down near this 10% level. 10%'s only occurred 5 times in history, 4 of which is shown on this graph. Markets, as you can imagine, had significant rallies. Of course, we did in 1996. As well as, well, all these years had significant rallies. I'll show you that in just a minute. Let me go to the world numbers, but I'm going to subtract China because China's numbers, as we know from the last year of negotiations, you can't trust anything China says, right? But realistically, I'm kind of kidding there. We did have big revisions in 1983 from China. We had big revisions in 2018 from China where they doubled their numbers. I mean, I just don't think they have a good handle on them. So let's just subtract them and see where the world is without them. And we're down to this very dangerous low level of 11% or below 12%. You don't get that low very often. And if you take those numbers that I just showed you on the US and subtract that from the world, you're going to be down just right at 10%. So you're in a very, very small world historical area of just 4 other times you've gotten this tight. What does that mean to prices? Well, if I use a formula that uses production versus consumption, and I change that production the way I just discussed, you get an economic value off price models of 477 to 488. So that would be way up here. Now, looking at this chart, this is a monthly corn chart. So it's kind of interesting because this week's low, just the low put in yesterday, came right down to this trend line and held that support. So nearby futures got right down to that 335 area and held. It also, if you look back horizontally, that was also a place that held last year in 2018. Now we snapped back pretty dramatically in the last 2 days, and some people are saying, well, I can't buy that. Well, I think that you need to reconsider that. One other thing that I wanted to show you is going back to this 2010-2013 rally was because world stocks were dropping down towards this danger zone. And in the United States, we were also dropping down below and did drop below 10% stocks to use. And that provided the fuel to go have a rally that was very significant in core. We were right down here at 10-year lows, just like we are right now. And for no foreseen future reason, but all of a sudden the fundamentals changed and the markets took off excessively and went all the way up to over $8 corn. Now, one another thing that was really pushing the market at that time was inflation, because in 2010, the Feds did some quantitative easing and went from a inflation target that was a negative to a positive target of 2%, and the inflation started to kick in. And traders, fund traders, when they know that there's an inflationary policy, they buy food and fuel because those are the two most inelastic markets. That's why they subtract that from the core inflation, and because you got to get to work. So whether we get $2 gas or $4 gas, you're going to buy gas. And same with food. You're going to buy food to feed your family. You may not be going out to restaurants, but you're going to be still buying some beef and pork and chicken. So the bottom line is, when you have an inflationary-based policy, Fed policy, funds will hedge their inflation risk by purchasing food and fuel. Based on what we're seeing in Washington and the significant sell-off that we're starting to see in the stock market, it's very possible, although it hasn't happened yet, that we could see the Feds take more of an easing type policy. And if they do, I would think that would be an incentive for some of these funds to come in and buy these 10-year lows that I was just showing you on those monthly corn charts. So why would you want to be buying December corn when the trend has been down and we want to be a hedger because we mostly farm? Well, there's a couple reasons. Number one, if you're an end user, you want to be buying 10-year low prices with the types of risks that I've just shown you. Number two, if you're a farmer and you think that there's a chance that you won't have ideal yields this year, you're going to be in a situation where you would like to collect on insurance. Well, if the prices go up dramatically, if we go to that target economic value of 477 to 488, you will cut your insurance payout even with a lower yield, because it's based on revenue, bushels times price. So buying options down here and locking in these 350 prices versus the $4 insurance price guarantees you that if you do have a yield loss, whatever the insurance adjusts down in their payment to you, you will gain in the call value of that option going up. So consider an insurance hedge by purchasing calls. The second reason a producer might want to buy calls is for hedge protection. Obviously, we've been living for the last 24 months, 2 years, with very, very intense pressure on cash flow. And the first time we get a chance to sell corn in the 410 to 420 area, we'd be foolish not to sell it to lock in profits. Having these calls bought now, or some calls bought now, would be a really good way to offset some of those sales in case these markets do go up and press towards the highs. You would have a neutral position if it goes up, but if it went down, you'd still be sold in that 410, 420 area. So I think that realistically, I'm just going to go back to the monthly chart. Here's the monthly chart. I think it's realistic to think that we've been going sideways here for long enough that we've built value into corn prices. I think it's realistic to think that with the changing fundamentals that we're seeing, that we have not seen the likes of for other than 4 other years that we can identify on the historical data. And comparing it with 1993, which was really one of the worst years in history, this is far bigger than the 93 situation. All of those reasons warrant buying this market down near these 10-year lows, and let's see what happens. Maybe we're going to go to that target, that economic value. Maybe we'll just get a technical rally up to this area of resistance. Maybe we'll get a rally up to the 10-year average price of corn, which is up here around 470, 466. Who knows? Maybe we'll have an inflation-based scenario where it brings fund money from being massively record short to being long, in which case you would probably exceed these objectives. We don't know the answers to that, and we don't even know how fully impacting this weather will be on us, at least for another 15 days, when we can start to quantify how many real acres will be set aside and prevent planted. One thing I do want to show you is this. Some people are like, well, I can't buy the market. We're 2 days off the low. Let me go back to here. This is the daily chart. Here was yesterday. Here's today. And they go, well, I can't buy that. That's already rallied so much. Well, let me show you what the hog market did when it bottomed. The hog market was going sideways forever, wearing people out left and right. Mexico wouldn't buy any hams because we never lowered their tariffs after the USMCA agreement. And it was a politically motivated, very negative environment. And all of a sudden the market bottomed, and then it closed higher the next day. Well, if you were waiting for a break to come back down here and retest that low, you never would have got it bought. This market rallied 73% from the $52 lows to the $90 highs. So if corn moves similar to that, how high would it go? Well, I know the answer to that because I've already done the calculations. But my point is, don't be afraid to buy a market just because it's rallied 2 days. You need to be looking at the big picture, and you need to realize that this thing could be really significant. We don't know to the extent of that again, but we will keep you informed on that. Now, where do you go from here? Well, where you go from here is call your agmarket.net broker. You could be looking at buying some futures, especially if you're an end user. You could be looking at buying some calls for anything from 20 cents on down. At the money calls this morning, we're trading for 20 to 24 cents. That's just a little more than what they require for futures. You could be putting on call spreads. You could be putting on synthetic longs where you buy a call, sell a put, selling a 340 put and buying a 360 call or 370 call. All of these are really good ideas, but you have to tailor the position to fit your risk tolerance, your cash flow requirements. That's all I have for you. This is Bill Biederman. I hope you've enjoyed this recording, and please give us a call at 844-4-AG-MARKET. Thank you.